All right, we'll go ahead and get started. Thank you for joining our webinar this morning on alternative investment due diligence. We have our host again, Chris Carsley, who's been with us for a few conversations now, who I'll pass it on over to as he dives into this subject.
Thanks, Rachel. Hello, everybody, and thanks for joining us. This is our third discussion around alternatives. The first one, we walked through what are alternatives. The second one, we walked through what is diversification. A lot of people actually talk about it, but we dove a little bit deeper, and then we applied the aspect of, well, how alternatives can be utilized and how they performed historically within diversification. And this one, as Rachel said, we're going to be walking through alternative investment due diligence. The part that for most people is not very much fun. It's a fair amount of work, and I do want to preface this. This is an introduction to the idea of due diligence. There are a plethora of different types of alternative investments, and a lot of them have a number of different idiosyncratic measures that need to be reviewed in a due diligence process that you might not find in the others. I just want to preface that right off the bat, that so if you guys have specific questions about a particular area that we didn't really dive into, please feel free to ask those questions. This presentation is also kind of broken into some very specific pieces, and I'm totally okay being interrupted. Ask a question, type it into chat, raise your hand. And then, Rachel or I will see that and we'll be able to address that question sort of live. But let's dive in because we do have a lot to cover. So let's, next sort of slide, let's look at our base agenda. We're going to cover, what is due diligence? And then we're going to break it into its pieces, which I think there's a lot of great books out there. There's a lot of great resources that you can dive into, and we'll talk about some of those. That will cover the investment aspect of due diligence, the operational aspect, and the business aspect of what due diligence is and what's required for alternative investments. Then we'll dive deeper into parts of due diligence broken into a number of direct categories that you'll have to focus on, and we'll talk about some of the expertise if you have a team that performs due diligence, some of the expertise that you might need on that team, or if you're performing due diligence on your own. It'll give you an idea of, well, the things that you need to be paying attention to, and hopefully you have the time and the wherewithal to cover that. And then lastly, we'll dive into some of the historical red flags. There are a number of things that have come up over the decades in due diligence that have been problems that have repeated themselves. And so if you see some of those that come up, well, immediately, it doesn't mean that funds are fraud or something like that. It's just something you need to be aware of, and you need to ask the right questions. And then I'm not going to ruin it too much in this presentation, but the next steps is part 4 of this series. We're going to dive into what are some of those questions that the professionals actually ask to dive in and sort of hunt out those red flags. So let's go ahead and dive in. What is due diligence? Well, simply put, due diligence is the process of performing analysis of an investment. Now you can interpret what competence, care, and thoroughness might mean. I'm not going to dive too much into that definition because we're going to cover a lot of that in the later slides. But at the base of it, if you're going to make an alternative investment, you have got to go in, you got to understand and analyze the investment itself. You got to understand, well, what are they trading? And this is where it gets complex, and it can go a lot of different ways. Maybe you're looking at a hedge fund, looking at a venture fund. Maybe you're looking at a real estate fund. Maybe it's debt, equity. Maybe you're doing a direct invest. You're an angel investor, and you're thinking about various aspects of what I should be considering myself due diligence with an individual company. That's where you're going to get a splintering of this conversation as we dive through and understand the investment itself. But here's where it gets a little more complex. If none of you on this call have been a securities analyst dealing with public securities, this process is very similar, but most of the information is available for you. In alternative investments, this information is not usually public, nor is it readily available as you dive in and try to understand the company and the team that's managing the investment. And that's a process we're definitely going to cover in the operational due diligence and business due diligence section. Well, why due diligence? It is painstaking. There's huge amounts of documentation to read through. There's a ton of things that need to be vetted and understood so that you understand if something does break, how is that team going to manage that problem, or what risks you're at as the investor within this investment. And I have a statement here that's pretty important. Performance alone is not a good indicator of future ability to generate excess returns. There are some types of investment that have what they call a persistence of return, which means if they had a positive return, they are more likely to have a positive return in future periods. You will find that there's a majority of your alternative investments, just like your traditional investments, they don't have a consistent, persistent level of return. So you need to really dive in and identify for yourself, and there again, the particular nature of the alternative investment you're looking at, to try and find, can this investment maintain through cycles, and can the team manage through cycles up and down? And everyone always says one thing, I don't invest based on performance. Well, you're kidding yourself. Most people do. You're not going to look at a fund and go, wow, these guys have really performed horribly. Maybe I should write a check to them. But we'll talk about some of the psychological and behavioral finance aspects of looking at performance and how else you need and what you need to think about above and beyond performance alone when doing alternative investments. Next slide. All right, here's the 3 big breakdown pieces. We talked a little bit about, hey, understanding the nature of the investment. The operational and the business side is where you're diving into the team and you're diving into, how the company is built. What have they built? What's their process and procedures? So let's walk through some of the questions that you can, sort of guide right off the bat is, what is the investment objective of the fund? Pretty important. You got to understand, how is this going to fit into my existing portfolio? Why do I want access to this? How does it behave? So in what markets, and the assets, does this fund manager invest in? Are they a hedge fund? Are they long short equity? Are they, an event-driven fund where, they're taking, a long short position in equities, or maybe, in relation to an event, or maybe they're structured debt. They're playing senior versus junior debt positions. Maybe it's a real estate fund. What type of equity positions are they taking? What's the structure of how they're putting that together? What is the fund manager's general investment strategy? Now, this is something that it sounds pretty simple to understand, but you got to understand how they wrote their documents. How are they going to invest your money? They say they're going to do X, Y, Z. Let's just use, a long short hedge fund, for example. And they say they're going to maintain certain exposures. They're going to be long a certain amount. They're going to be short, and maybe they focus primarily on small cap stocks. And all of a sudden, you're looking at their portfolio, and parts of their portfolio, maybe they have a massive concentration, or maybe they kind of started going in and shorting large cap stocks, or maybe they started shorting, ETFs and indexes instead of direct securities that might, they might have an edge in creating alpha or something of that nature. You need to dive in, understand their strategy and how much they're going to stick to it, and what kind of variance, what kind of style drift can they have. If you're reading through a document and they throw the kitchen sink at you as their investment strategy, well, that's probably something, you may be investing in one thing today and tomorrow it's totally different, and it maybe have an adverse effect to your portfolio. What is the fund's benchmark? Now, I come from a background where we benchmarked everything. We needed to understand a relative return based on, if I could go get a investable benchmark. I'm not going to dive too much into benchmarks because that's a whole nother 3-hour discussion. But if I can go in and I can go buy an ETF or an index that is investable, and there's a certain level of correlation and understanding, or best fit, a statistical fit to this strategy, well, I need to understand, okay, that's maybe a best fit index, that's a best fit investable measure that I can say, is this manager, I'm paying fees for this, is this manager creating value above that index net of fees? So in my mind, and I'm biased because this is the way I've always thought about the world, because I've been benchmarked since I walked out of college and got into investments. You need to think about that. Can you actually come up with a benchmark? Has the fund thought about what their best benchmark to? So another question there. What is the investment process of the fund manager? This is sort of a step out of what they're actually investing in, and more, how do they, source the trade? How do, what's their sourcing capability? What's a little bit getting into, their edge? Is it repeatable? One of the things is you might find a number of different strategies that fit a certain time period, and they make a lot of excess return within a certain time period, but then that trade goes away. Spreads widen and collapse all the time. So you need to understand, is this one of these trades? Is this something I'm in for the next year because it's opportunistic, but it might disappear, and then the fund, will be creating excess returns. That repeatability of the team to be able to continually do what they do is super important. Assessment of possible failure of execution of investment strategy. Okay, what does that really mean? Well, this is how they built their team. There's a number of ways to fail within the investment execution. It could be a trade error. It could be wrongfully negotiated contract. I mean, there's a number of ways. You need to understand what's the complexity of how they actually pull their trades off and where mistakes can happen. If you've got 10 people involved in trying to get a trade done, there's a lot of potential for human error. So a number of things to think about with how is this trade executed? How can it break? And what process and procedure does this manager have in place to mitigate that execution risk? So that's a little bit, we're sort of diving more into a little bit more of the operational business side, and then, lastly, you've got, sorry, the screen blanked out for a second. You've got, what is the nature and the source of any value added by the manager? Now, this is that is going right at the edge. You'll see, if you ever listen to me talk, I'll talk about two key factors, even though we've broken it down into three pieces here. I'll usually mention something about inefficiency and edge. What inefficiency is the investment taking advantage of, and the edge? Does the operational structure and the business structure of the manager and their knowledge base allow them to take advantage of that inefficiency? So here, you're talking about what's their particular edge? What do they have? Do they have an information edge where they are able to obtain information that is not readily available to other investors so they can be ahead of the game? There's a number of investors, both traditional and alternative, that have that ability. Is it network? If you're thinking about venture, one of the most important aspects of a good venture fund is that historical track record and success of those shops really generates a network where they're seeing some of the better deals. They're consistently getting quality teams that are coming and running startups. So they're the ones funding, those best teams, and they have the right network. And then that network expands into, well, not only can the venture company do something for the fund, can they make introductions to help out with new clients, sales, business development? Can that venture fund really help their startup company, move to the next level? And some of the best, that's their edge, is their network. They have all the right phone numbers. And then sometimes it's systems. Maybe you've got something like, one of the best is, quant managers who might be doing small trades at rapid speed. One of the things that you want to understand is, do they have the right systems and the programming, the coding, and the knowledge within the team to execute consistently on that investment strategy, and that their system will allow them to, continue to move forward and deploy that edge. So those are some of the key aspects you got to think about with regards to the overlapping circle between investment management and operations. It's everything links. You'll find that I was going to save this for later, but it's a perfect time to kind of talk about it. In the early days of the explosion of operational due diligence in 2009, because everyone realized no one was really doing any operational due diligence before 2008 occurred. They were just piling in money and just hunting returns and going after the investment strategy. A number of people, they realized, well, there was this schism of who should be doing operational due diligence, who should be doing investment due diligence, and should those teams relate to each other in some way? And I know this sounds funny now, but at first people were thinking, due to potential Chinese wall issues, those should be totally separate from each other. And I just applied logic, and seeing how, as I've worked on the operational side and built funds, and I've worked on the investment side as trading and understanding trades, it made a natural fit for me to kind of have them do both at the same time. And there needs to be an overlap between those teams and an understanding, because in some ways, some investments, you have to understand the operations in the business and how that's actually being completed effectively. If you just looked at the investment side in isolation, you wouldn't have the full picture. And if you looked at just the operational side without understanding the nuance of the investment and what it takes to complete it, you also were only looking at half the puzzle. So in today's world, I think things have become more understood that at some level there needs to be a pretty good overlap between the due diligence of these two sections. All right, move on to the next slide. And some people, I told you, man, you might argue with me, and that's an ongoing conversation of how much that overlap should be, and there's all kinds of conflicts of conflicts that can arise because investment teams, they don't really think about the operational risks. They think about the investment risks, and so they may want to jump into an investment, and the operational due diligence people, DK a trade and say, oh no, that's not going to work because these guys don't have even the basic structure set up, regardless of the investment acumen of the team or the potential opportunity and excess return in the investment. So one thing is now a perfect segue into operational due diligence. One key point to walk away with: operational risk is a risk you take in alternative investments, and it's something you're not rewarded for. Everyone here probably has heard of the risk-reward equation. If I take a certain amount of risk, I want a reward that's commensurate with my risk. That is not something that translates easily or mathematically. When someone is taking an operational risk, it may not transfer to reward. Now, the other side of that coin is there are what some people have realized operational alphas. You can actually have operations and systems or networks in place that actually enhance the return of your investment. And just like I mentioned earlier, obviously, if I have a startup company within my venture fund and I have the ability to deploy operational network, that's going to increase the return. That wasn't necessarily, obviously it's related to the nature of the startup company, but I'm the one that enhanced that return, i.e. creating an operational alpha for my fund. So something to think about from that standpoint. Operational risk, according to the International Association of Quantitative Finance, is the loss caused by problems with people, process, and technology, and external events. Looks like we had some duplicated words there, so I apologize for that. And some of that we've already talked about. One of the key, you'll see the note on there, it's estimated that, and this is kind of surprising to most people who haven't read up on this subject, most alternative funds don't fail due to the investment. They fail due to some operational failure, a fairly large amount, 50 to 66%. And it's accounting errors, or it's accounting fraud, or some level of embezzlement. It literally had nothing to do with the investment. It was because they did not have process and procedure in place for the protection of cash movements or proper monitoring of the mid-office and back office. So a number of different occurrences have happened across all kinds of different funds where the investment people were completely unaware of what was going to eventually blow up their fund. And it happens more often than not. With that said, I also want to let you know that operational due diligence in isolation is not this magic tool that finds frauds. In my years of working for a large fund-to-fund, almost all the frauds we discovered, the process started on the investment side. And you kind of said, well, hey, that's their due. Let's go see if the same matches. And there again, that overlap between investment and operational is what really determined something's not right here. Something doesn't make sense. And there you might have a fraud. And so it's very hard to prove frauds. It takes years, as we all know, if we've read the history of a lot of things that occurred post 2008. I state there, operational risk, includes middle and back office functions that are directly related to the investment process. That's a key differential. So you have a number of different processes and systems and people that directly touch the investment. They are the operations offices that maybe is part of a custodian, or they're something within the prime brokerage. They're within financing, something that has to do with directly related to the investment. And so we can move on. I think I've talked enough about operational due diligence. I mean, it's a subject that's near and dear to my heart, because I've built entire teams and certainly recognize the importance of operations within an alternative investment. And I think people do focus, rightfully so, heavily on the investment itself, but at the expense of not really understanding that operational due diligence will tell you how the manager is protecting you as an investor. What process and procedures have they put in place? What third parties have they put in place? There's just tons of different factors that go into that, and we'll dive into some of that later. So what is business due diligence if we just talked about operational? Well, business risk is, well, the activities in the business pieces of the business that are indirectly supporting the investment. So human resources, technology and IT, office equipment, in physical locations. So to give you a couple examples there, I mean, in human resources, if they don't have a good program that's doing proper background checks for employees coming in, and they're not vetting, I mean, who knows who could be effectively working at the fund that you're about to invest in. They also, I mean, there's been a number of different mentions. I've never run into it personally, but there's been people who have been exaggerating on their resumes, saying that they did certain things or have a knowledge base of something. What is their process of onboarding people? How strict is it? I know that where I worked, a lot of places, it was very hard to be hired. You had to take like tests and walk through an example of, hey, here's a real trade. What would you do? So understanding how they're onboarding and how they're even the ongoing monitoring of their employees. I mean, obviously human resources has become monumentally more important over the last few decades, not only in the hiring aspect, but the ongoing monitoring and maintenance of the culture of the company. Making sure that there's, the right culture and there's no, bullying or a variety of other things that are, certainly can happen in, a room full of type A people working at an investment shop. Let's just call a spade a spade. Technology and IT support. This has been just an explosion over the last decade. This is very important to understand who's in charge of this, who's maintaining it, how it's operating. This is just a key aspect to the efficiency of the company. And one, the safety, I mean, the other side of it, a lot of part of disaster recovery plans these days are directly related to hacking, the protection of investor information. So this is a really important aspect of, the business due diligence, as it has really become paramount to, running almost any business these days, especially in the investment management world, where investors are demanding more. And, there's only so much you can put on the plate, and how else are you going to create efficiencies? In the old days, we could just hire more people. Well, that's not always the answer nowadays, because then maybe the business becomes cost inefficient because you're running a relatively small fund in a capacity constrained trade. You can't just throw people at a problem. Office equipment infrastructure. Okay, this really requires, and it's kind of interesting because not a lot of people doing on-site verification anymore. It's coming back. I've talked to a lot of people who work in due diligence, and they are getting back to the routine of now requiring on-site verification and walking through and understanding. And it kind of goes back to the physical site. Is the physical site safe? Is it secure? Can people just walk in? I kid you not. Back in the day, pre-08, I was going to do a review of a hedge fund. I just walked into their office, realized there was no secretary, just walked right in and just went right to the trade desk and sat down in front of an open terminal. I didn't work for that hedge fund, but I was literally sitting in the heart of their decision making. That's a problem. You shouldn't allow people from outside just walking in off the street randomly, and they can walk right into the heart of your operation. And so what's the physical layout? Is it secure? When you're there, given the nature of what they need to trade, do they have the right office equipment? Do they have the right systems in place? a lot of people have taken a lot of different steps around cash management and control, dedicated, computers for cash management and wires. So assess that, understand if it's a big fund, what are they doing? Because they have the people and the systems and the money and the capability to put these safety protocols in place. What are they doing? So that's additional assessment. If you're working for a large shop or a family office that's writing big checks, you should take the 10 or 15 minutes it takes to assess that and just understand, hey, to the nth degree, how many safety protocols do they have in place that protects my money and protects themselves as a business? All right, moving on. All right, this is where we can dive into, and I'll totally admit, I give full credit to one of the organizations I work with, the Chartered Alternative Investment Association. They break due diligence down into these pieces. And I like this breakdown because it goes and says, okay, great. These are the sections. If I'm going to sit down and look at an alternative investment, I need to understand fund structure. I need to understand strategy, the administration of the fund. Yes, we need to understand performance and do a performance assessment. We need to understand portfolio risk, and we'll talk a little bit about that because there's two aspects of one, how you view risk and how it might pertain to you individually as an investor, but you're also looking at a situation of where, how does the fund view its risks? And that's a very important question. And having run a number of funds, it's a question I get very rarely. Very rarely do people say, what do you think your risks are? How are you mitigating your risks? Or, it's like, well, what's going to break the trade? Legal, and do your references. There's a number of ways to do references. I'm not saying one is better than the other, but we'll talk a little bit about some of the aspects of references. And then what I'd already talked about earlier a little bit was the comeback of on-site verification. Trust but verify. You got to go see if these people really exist to some extent. And that's an interesting dynamic because even for me, I run a small fund and, we have an office, but, a lot of times maybe that day I'm working from home. Things have become very, very virtual. They've been very, you can run a variety of different company aspects from a lot of different places. With that said, how are they protecting those mobile laptops, those devices, those connections from being hacked? So let's jump into fund structure. And this is where I said, this is very broken into pieces. So anyone's got any questions at any particular time, jump in. Love to answer anything that you think I haven't covered or something that maybe is particular to, a project you're working at right now. So obviously one of the first things is legal formation. How is the fund built? Now you've got an SS, what are the complexities? What conflicts are in place? There's always conflicts of interest between parties who are running a business and parties, i.e. vendors or customers of a business. Doesn't matter. It's just a matter of how they're identified. Make sure you understand what those are and have a conversation with the manager of the fund or the company, whichever one you're looking at, alternative structure, how they're dealing with some of those conflicts. Tax impacts are super huge. There's a number of different investors. I know most of you on the phone might be US-based investors, but what if you're a foreign investor looking at a US fund? Well, I don't want to pay US taxes. What if they built as offshore capabilities to shield me from US taxes? So there's a number of things to think about there again in the structure and the legal formation that helps mitigate and allow investors to come in the way they need to. Maintenance costs. How much does it cost to just sort of maintain what we've built? Understanding, and this also, I'd like to back up one thing also is how much did they pay to build this company? It's one of the things that a lot of people sort of forget to ask. And a lot of new people to building funds, they go to their lawyer, they pay full freight for a template, maybe a few tweaks and changes, and they just don't know any better that in today's world, the ability to create an alternative investment platform is getting cheaper and cheaper. And that depends. There's some complexities. I know some people who've got multiple legs to their fund, and it still can cost hundreds of thousands of dollars to create. But if you're looking at a relatively simple investment that's US domestic based, you're a US investor, it shouldn't have cost too much to build it. And so it can give you an indicator of like, okay, did these people really know what they were doing? Did they pay too much? And understand, the complexities. Ask the question like, oh, wow, it cost you $150,000 to build this fund. Walk me through why. What was it that was unique that cost so much? Because it is getting cheaper, and there's tons of lawyers out there that recognize it's a world of templates, and they can actually get a lot done. This is a wheel that's been invented tens of thousands of times. There's not a huge number of changes. Proper regulatory structure and filings. This is super important. What are their exemptions, from, the 40 Act, from, SEC filing? Have they built their fund correctly from a regulatory standpoint? Do they have if it's a Reg D fund, do they have their Reg D in place? When was the last filing? When was it updated? Do they have dedicated legal that actually helped create that? Maybe that's a phone call you make and kind of talk about, maintenance and updating, the filing that this fund might require. If you're unaware, part of due diligence is also a learning process. I always tell people, yes, it's a lot of work, but you also have the ability to dive in and really understand how people build something that's relatively complex. It's a huge educational, aspect to this process. If it's something you want to learn how to do. Geography. Where's their home office? Do they have satellite offices? How are those satellite offices reviewed, controlled? What functionalities happen in home office and what happens in satellites? It's good to understand where are the key people located that are driving the nature of this fund. Are they all in the same place? Are they geographically separate from each other? How do they create effective communication to complete the strategy? And as we talked about earlier, the complications of post-pandemic, when you're dealing with geography, it's become more complex. You might have, an alternate investment opportunity where people might even be in foreign countries. And so that's something you should understand. Okay, well, the people who are, pulling the trigger on something, they're not even within US borders. And maybe you're in Europe and you may have the same issue of like, well, wait, they're not actually in Europe. We're the guy in control of it, he's in Canada. So how does that actually dynamically work out? And what problems can the fund occur due to time zone differences, and how are they mitigating that? And then on to, personnel. Do your background checks. Understand previous jobs. Have they run funds before? How successful were they in those funds? Whether it's the same strategy or not. I'll be honest with you, there's a lot of smart people out there. And you may have one guy who was off doing long short, and he takes the base knowledge and then he finds an esoteric trade nature, and he's out there doing a trade that's more event driven, like appraisal rights or something of that nature. It doesn't mean a lot of those skills are not transferable, and he's not doing the same thing. And I know a lot of people get kind of hung up on that, like, well, are you doing the same thing exactly? I know a ton of managers who have been very successful at one strategy, within their career moved on to another strategy, and they were equally as successful, because there is an overlap to the way the investment is run or maintained. And then understand the variety of skills within the entity. Do they have the right people to pull off their trade? And I'll give you a perfect example. I walked into a hedge fund manager in New York, and they were doing a number of trades that were event driven, that were based on corporate actions. And the first question I asked, because I actually did this when I worked at a hedge fund, was I did event driven trades that were reliant on corporate action officers and making sure you have the borrow of right stock and things like that have the right elections. And so I asked the fund, I go, well, where's your corporate actions officer? And they actually had one, so that was surprising. And I spent time with him and walked through what he does and how he gets this done, because in their particular trade that they were working on, it was very, very important. This person had a network and had the knowledge base of corporate actions so that they could actually go effectively borrow stock, that could meet their event-driven trade. It would have been problematic if they had said they were doing this trade and they didn't have anybody internal with the right skills and network to actually carry out what I thought was the most important aspect of that particular trade. So those are things that you can think about. And I know that gets kind of deep, but if you're looking at more and more complex strategies, well, you should understand, how it actually works. Because when it breaks and you're all standing there going, well, how did it break? You should already know how it should break. And when it does break, you'll understand not only, yeah, I knew they told me that could happen, and two, I understand how they're going to mitigate it. That's where you should be positioning yourself post due diligence, not standing flat-footed and just getting a phone call of, oh yeah, we lost a lot of money, and you don't know what happened. And then post 2008, the rise of the service providers, all very important. Probably one of the biggest shifts that we've seen post 2008 was the fund administrator. A lot of funds were self-administered, and that day was over. Or you had a fund administrator that your fund group owned. None of that was compliant anymore. And you now needed a third-party administrator looking over your shoulder, running performance, running accounting, and you're accepting, and they're working on perhaps even valuation aspects as well, depending on the level and the complexity of the administrator. But does the fund have a third-party administrator, and how do they impact the fund and integrate banking? This area is in a schism too, because a lot of people historically wanted to work with a big name bank, but they're finding some of the functionality and what they really need from a bank is cheaper and more accessible, and they have better customer service from smaller banks. So now you're seeing some major funds or mid-tier funds not using some of the big name, global banks. They're using more super regionals or something, relatively local based on their trade. So recognize that it's all, don't get caught up in like name dropping. Like you pull up a deck for a fund and it's nothing but big names. That's great, that's fine. But are they getting the best pricing, and are they getting the functionality and the customer service they need from their service providers? Because at the end of the day, as an investor, you got to remember, all the expenses for all these service providers, they're your expense. You're the one eating that cost because the cost rolls to the fund. So this is where you need to understand, if you're dealing with something where there's a requirement of, collateralized financing or custodial work, you got a prime broker involved in the situation. So understand the prime broker. What does the prime broker facilitate for the fund specifically? What are some of the terms that the prime broker offers for the strategy? That's very important to understand, because historically I've seen a number of funds where you got to have a prime broker, but that prime broker can come back on you and really, squeeze a fund in a way because they, didn't have leniency in their terms for different market events that occurred. Same with custodians. And then legal. Well, there's different kinds of legal. There are big shops that have access to every type of legal you'd want. So maybe they have access to that kind of legal. If it's a smaller fund, do they have securities law? Do they have corporate law? Do they have I know a lot of people in the real estate space, they have dedicated, legal that specializes in, real estate, specifically on the foreclosure side. So identify the various pieces and apply a lot of common sense and logic. Do they have the right people? And are those people in a position to look over the shoulder and really make sure these people are doing what they say they do and in the most efficient manner? Because at the end of the day, you want these service providers not only to service and function the fund, you want them to be there as other parties looking over the shoulder of this fund, hopefully within, with your best interest as the investor. And then tax nod. This may, obviously tax is always going to be a play in these investments, whether it's either forming 1099s or K1s, whatever tends to be put together for the fund. But the other aspect is, are they even audited? Not every fund is audited. It's not a requirement, but you'll mostly find that your larger investors or your investors or your funds on the way to being what they want to say institutional quality. That's an open definition. They'll usually have audited financials. It's another mechanism of someone looking over their shoulder, making sure books and records work with, and understand that audit works with the administrator as well. It doesn't do any good if audit's just taking numbers and information from the fund. Well, I mean, the fund could be fabricating something, and audit may check into it, may not. But the thing is if you combine enough people in the daisy chain that aren't related to the fund, that are securing and verifying and reconciling numbers, your most institutional type structure, you would see audit really take information from the administrator, not really from the fund, because the administrator should have all that information anyways. And so now you've got two third parties, working together to ensure the fund is doing something right, instead of having the fund materially involved in supplying information directly that could be fraudulent. So I sort of have a state down there: is your house made of straw or brick? That's what this whole section is about. And when you're understanding fund structure, is the foundation solid? Is my house solid, or is it just, man, it's going to be really easy to blow over, or it's going to be easy for things to go wrong? And that could be a variety of things. Let's jump into next one is investment strategy. Obviously, incredibly important. This is where most people spend most of their time. This is what fascinates most people. This is the cool part of due diligence. This is where everybody wants to, be the expert in it. And I'll admit, I even think the same thing. But as I stated earlier, a lot of this investment strategy doesn't work if the rest of it's not built. I always say, listen, last time I checked, the top of a pyramid doesn't float magically. You got to have the middle and the bottom, or the top falls. And so on investment strategy, you're looking at markets. What markets and securities do they trade? We talked a little bit about that. Are they in public markets? Are they using public market instruments and combining them in a variety of ways? Are they using derivatives? Are they creating their own over-the-counter derivatives? There's a variety of different structures in alternative investments. What are they operating in? What are they trading? What's within the portfolio? And that's also, this we talked about, kind of dives into products. It's like, okay, well, understand the nature and the inherent risks. One of the things is derivatives are not inherently bad. I've used them in almost every career I've ever had in investment management. It's just understand how they're using it, because there is an inherent leverage factor in them. Like if you're going to go look at a managed futures, how are they structuring and how many dollars are they deploying versus futures contracts? Futures, especially in something like foreign currency, can be massively levered, to an unbelievable extent. You need to understand that, not only, oh, they're using derivatives. Well, they're using derivatives, and how are they using it? That's the important aspect. Their counterparties. What do they need to make this strategy happen? Like we mentioned earlier, that kind of goes a little bit back into some of the service providers. If I'm running a long short hedge fund, well, I'm obviously going to need a prime broker. Who am I using? How do they facilitate, what I need done? And, what are some of the terms? Netting effects, cash controls, things like that. But there may be other counterparties. One of the things that a lot of people learned as the world tried to collapse on itself in 2008 was a lot of counterparties were needed for these very esoteric alternative strategies, and they didn't realize how many people were involved and how they were all daisy chained together. So when you let one fall, it was a domino effect. All of a sudden, a whole bunch of people suffered. And I don't think the government quite knew what they were doing when they let Lehman fail. That was the domino that they pushed over, and it hit other major banks almost immediately. And so it was this mad race to save the next domino. So yeah, understand the counterparties. What do they really need to have in place to facilitate their trade? Trade examples, super important. And don't fall prey to this, like, hey, here's my investment deck, and I'm going to show you all the great trades I made money on. Anyone who tells you they've never lost money doing anything ever in investments is either unbelievably rare. We're talking making unicorns look common, or they're full of it. If you're like me and you've done a lot of different kinds of trades, definitely had my head handed to me on a couple of them for sure. But yeah, look at the positive trades, use those as an example to kind of understand, okay, this is the kind of thing that's in the portfolio, but take the time. Well, what didn't work? What trade didn't work? Or what gave you trouble within this particular investment? And, why did it break? And what did you add to your due diligence process, Mr. Manager, so that maybe that doesn't happen in the future? Or is that something that's, maybe could happen again? It's important to understand that. And one of the things we used to do when going in and doing due diligence is I certainly wouldn't let the manager pick the trades he wanted to show me. I'd be like, no, let's go in and take a look at your book, and I'm going to pick the trade, and we're going to walk through that. And sometimes I'd pick an old trade, I'd pick trades that didn't work. And if I was lucky enough, I was sitting on the trading desk, I might look at a live trade that was just put in that morning and then kind of walk through that entire trade. There again, that depends on your timing and the nature of what type of due diligence you're doing. If you're just an individual investor, you may not have that time or resource to afford the cost of doing that level of due diligence. But if you are part of a team, you should be taking that time to walk through some, all kinds of different trades. Here again, benchmarking. It is very challenging because the nature of alternative investments is to not be common and easily, understood. Otherwise, you'd probably be a traditional instrument traded on some exchange. So it can be very difficult to determine what is the best fit index to understand and benchmark, is this manager producing value? I'll give you examples of when we were benchmarking hedge funds. Often not, you might have a benchmark that's made up of a weighted balance of 2 or 3 different components to create a best fit with what they're doing. And sometimes that benchmark would have to change, sometimes as often as each quarter. So, I mean, that's getting pretty deep, and you're getting into kind of like what the professionals are doing. For you, I think one of the easiest ways, if you're just an individual investor, dive in, ask the manager, how are they benchmarking themselves? How do they assess that they're adding value, and understand that process? And if it makes sense to you, great. If someone comes in and says, hey, I'm a debt trader and here's how I beat the S&P 500, you should probably think twice about investing with that person, because their chosen benchmark is not even remotely related to what they're trading. So something to be aware of. I know a lot of people, will compare themselves that is just not even a best fit. So you're going to have to press on them a little bit if you run into a manager who's doing that. Hopefully you don't. I hope benchmarking has been around long enough, and most of the fund managers out there realize comparing apples and oranges is not the best idea, but it still happens. That kind of going back to the trade examples, review current positions. In real estate, hey, let's walk through the properties. It's actually law now for hedge funds on a lagged quarterly basis. They got to disclose their positions, so you can actually pull that up. It should be public. They should have no problem sending that to you. If you're talking to a venture company, I mean, one of the things is, they're out there publicizing what they own, trying to build rapport for the company that's within their fund. So they should have no problem walking through the number of companies that are in their fund. So it should be something that's easily obtainable in a variety of different ways. But be sure you do that. Understand what the current portfolio looks like, and then you can ask the next question of, well, what else is next for the portfolio. Market cycles. We talked about that a little bit earlier. Does this strategy work in certain market cycles and not in others? There's a lot of alternative investments, or what they call cyclical. Well, they work in some areas and they don't in others. Identify what those are. Are you in this fund? Are you sizing this investment correctly at the right time? And this also gets into and kind of links back to looking at the trades that failed. Maybe those trades that you looked at failed. Was it related to a certain time or event? Something that was happening, on a global macro basis. So understand how this strategy structure, works in various market cycles. Sourcing, how do they source it? Is it repeatable? Is it difficult to source? Is there a moat around their sourcing? Is it easy for just anybody to go source this? Or do they have a particular niche? What's their current AUM? I know a lot of people think the larger the AUM, the better. Well, but that's not always the answer. What if the fund has a capacity constrained trade? Well, then all of a sudden, if you're in a capacity constrained trade and you're managing $1 billion, you're probably failing somewhere. I'll give you a perfectly good example. I ran into a long short hedge fund manager out of California, and he was managing around $200 million. And he was actually producing alpha on longs and shorts. I will tell you that is rare. Not everybody does that consistently. And one of his key things is he understood his capacity. He literally knew that, wow, I got to be able to make money on my shorts. That's my differentiating trade to why people are investing in me. And when I can't do that and it's a size issue, I got to resize the fund. And he ran into an issue where he couldn't get proper shorts the way he wanted to. And he returned like $100 million and said, well, I'll come back and ask for more money when the market changes, but I can't add value the way I want to due to the capacity constrained nature of what I'm doing. So he was very proactive in running his AUM. I'm just going to be honest with you. That was an extremely rare find, that individual and the mentality. Most people who get your money, they'll do almost everything not to return it to you because they want to keep the AUM. It's one of the issues now with, people are like, wow, their large private equity has so much cash sitting on the sidelines, but they continue to raise. How is that? What dynamic? What is that going to create in the future? We don't know yet, but it is concerning when they already have a ton of cash on the side, yet they're continuing to raise. Leverage. Everyone's like, I don't want to invest in anything that uses leverage. That's how you lose your money. Potentially. But leverage in itself is and can be extremely useful given the nature of the investment strategy. Are they using leverage properly? Does the investment only make sense if I deploy a lot of leverage? Maybe that's a concern. And that's a better question to ask is, can this put up a return or have the possibility of creating a return that meets my, requirements, my required return without leverage? And if they have a little bit of leverage, is the leverage, like in that situation, it would be strategic. So leverage is strategic because the investment really won't work without it. Or is it tactical? Is it a tactical deployment of leverage to where they don't really need it, but given the various structure, they can increase efficiencies in the use of leverage. Maybe, how venture uses, line of credit or something of that nature. Or a small fund is like, hey, I want increased capacity utilization of my investor dollars, and I got chunky trades. So a little line of credit will allow me to make sure that I'm always deploying my investor dollars at 100%. So there are aspects of where leverage can be extremely useful. Dive in deeper. Don't just be blind and say leverage is bad. Now, if you are in a trade that doesn't require leverage and they're massively levered, approach with caution. It can turn around. I mean, everyone's probably heard this saying before, leverage is a two-edged sword. Strikes cleanly when it's in your favor. It also strikes cleanly right into your face when it's not. So it can be extremely damaging to your return. And also understand the nature of how they built the fund structure. If they deploy leverage, can you lose more money than you put in? You're a limited partner. You should have language in your document that says that's not possible. Just make sure that if the leverage blows up and there's a problem, that's going back to the GP, not you. And then last, but certainly not least, is valuation. I've written an entire paper with one of my good friends, John Canaro. We believe there's a ton of different issues that people are not assessing and doing proper due diligence on valuation. And the core angle, what we're looking for there is, how are they valuing the assets? Who's valuing it? And how often? Always approach with caution. Doesn't mean it's bad or they're doing anything wrong. If they run all their valuations internally and the manager is driving, valuation, that can be a problem. Because you got to remember, valuation is important because that's the cost you're getting in for, and that's actually the cost you're getting out for. And it's probably the notion of the value of the portfolio of how you're being charged your management fees. Pretty important to understand how they're thinking about valuation and who runs it and how often it's marked. And who's double checking it. Do they have a third party? that's actually running valuation outside. So all important aspects. And that, I mean, we wrote a 10-page paper on valuation. There again, that's a subject you could go on for hours about, but let's move on. We spent a lot of time. It's very important investments, but the administration, we talked a little about that. Operational efficiencies, it can be a source of alpha. You know, their systems can increase return. Their process and policies, understand, dive in. Do they actually have a policy and procedures manual? I mean, listen, it's something you should ask for, and you know, you can read through it and understand in the day in the life of this fund, this is how they deal with everything. Have they gone through and created SOPs? Do they have standard operating procedures in place, whether it be middle, back office, you know, trading desk? There again, background checks. You need to run your background checks. Do your background checks on, you know, the managers, the key people that are decision makers and drivers of the fund. Also understand and say, hey, you know, you did your employee checks. Is that something at a high level? There's a number of information they can't share, but what can they share so that you can understand, you know, who's working there? Staffing and turnover. Do they have enough staffing? Do they have enough people to pull off the job they're talking about? What's been the turnover? I mean, obviously, if you've got any business that has a lot of turnover, it's a revolving door issue, you know, that's concerning, you know, and especially if you've identified a key person and that person moves on, is there language in the fund structure that like, oh, wow, the guy who's driving all the alpha, the actual trader left? That's pretty important. You know, we ran into one example that actually ended up into a series of SEC indictments and everything else was they had, this one fund had two funds and they migrated, all the investor dollars was in fund A and all the partners' money was in fund B, and all the skilled traders went and worked with fund B. So obviously that's a real big problem. You basically took all the skill set and moved it over to manage the partners' money, i.e. the partners of the fund. You are no longer capturing that skill set for where the investor dollars were. I mean, you laugh, these things happen. It's really crazy. Business continuity, you know, disaster recovery plans. That gets back to your technology. You know, if there's earthquakes, power outages, lack of internet, how do they move? Do they have an offsite in place? How do they make that happen? And then I'm not going to dive into this, but technology applies to everything above in today's world. So what are they putting in place and how is that working? And I have a statement down at the bottom there, you know, AM does not imply institutional quality of operations. Just because somebody's got a lot of money doesn't mean they've actually taken the time to reconfigure the operations and the procedures and the policies of the company. So make sure you're assessing that. All right, performance. This is quantitative. You're running the statistics of your risk measures, your attributions. Performance is super important. What I mentioned earlier is a little bit of that behavioral finance aspect, the herd behavior. And this is up to you. You get to make a choice of how you want to think about this. Maybe you're diligent enough that you won't be swayed. Some people complete all the other due diligence factors first and then look at performance, because they don't want to dive in and be wowed by the performance. And now what they have is a bias towards the fund. So everything else you look at through your due diligence process is now biased psychologically because you already like them. So now you're more bent to cut corners, overlook certain things because you're biased by performance. So that's sort of one of the things that they define as, that herd behavior. That's something you'll have to, do yourself. A lot of bigger teams, they separate the two aspects. So they'll merge at a later time to discuss, how the investment, not so much the performance, how the investment operates, operations and business, and then they'll dive in and understand, have they been successful through all the other three pieces to create positive performance. We mentioned this earlier, external track records. You can get the managers at, previous businesses they've worked at, were they successful at a previous business and managing money. AUM volatility kind of goes back to what we were talking about with the capacity issues, is how is this fund affected if AUM grows quickly, or do they have the liquidity capability to take on redemptions? If you have a gap event where people need liquidity, how fast can they get liquidity, and how will that potentially impact the strategy and the other investors that are staying in the fund? It was a very, very big problem for a lot of funds in 2008. They were hurt by other people trying to all crowd through the door too quickly, and frauds. Everyone sort of dives in and thinks due diligence is the effort of finding frauds. Yeah, that may fall out of it, but that really shouldn't be your primary focus. It should be more of, is this something that actually works for what I'm looking for to add to my portfolio? Obviously, if a bunch of red flags pop up, okay, don't invest. But it is pretty complex to find a fraud. It is not as easy as you may read in the news. It takes a lot of people who have dedicated their life to doing this job of due diligence, and even they get fooled sometimes. So I would just say that it's like that'll fall out of this process, but it's not a driver. All right, let's move on. Portfolio risk. This is pretty quick. We don't have to spend too much time on this one. You need to understand the internal risks. How does the company perceive their own risk? That's a great question. Ask that right off the bat. How are they perceiving risk? How are they mitigating it? What things have they put in place to help mitigate that? And how do they monitor it? How do they measure it? And is it something you can get access to on a regular basis? Hey, every quarter you're running this, can you send over the risk measures? Do they use an external risk company? There's a lot of people who do for some of you, definitely your mid-tier and your bigger funds, they use external risk companies that come in and run a number of measures. I'm not saying that's a positive or a negative. It's just another outlet for potentially more information for you to make your assessment. How much does this manager understand their own risks? Because I always believed it's sort of a risk first mentality. The key to investing is make sure you're not losing money. You obviously want to make money. You want to be rewarded for the risk you're taking, but crawling out of a big negative hole is literally doubly as hard, than just trying to avoid it. Counterparty risk. This was one that came to light over the years. It's a risk, there again, like operational risk, you're not really paid for. One of the perfect examples I have here is I work for a company that had swaps. For people who don't know what swaps are, they're a custom agreement for access to an investment instrument. This one in particular was access to the Lehman Aggregate Bond Index, which is now, I think, owned by Bloomberg. And we had a swap for millions of dollars of access to this. And it's something where, okay, who's monitoring those? Who's maintaining that and making sure our exposure is correct? But regardless of the monitoring, with the events that occurred to Lehman, you were just at a loss. I mean, you had millions of dollars exposure to Lehman, who was holding your cash. And when they went down, the chance of you getting it was close to zero. And it was a very, very long process to even recoup cents on the dollar. So counterparty risk is real. It can happen, and you can have a lot of errors that can occur. Lehman isn't the extreme example, but there's a lot of other examples of, where administrators didn't do the right thing or sent money to the wrong place. I mean, there is risk there. So assess what that might be, or there again, ask the manager what they think it might be. I always love this saying. I can't remember who told me this years ago. When you're assessing risk, you don't get bit by the dog you're watching. You get bit by the dog you don't see. And so that's where you kind of want your head on a swivel as much as possible and understand as much about the risks within an alternative investment. Doesn't mean you're not going to get bit. It just means the probability of you getting bit goes down. Next slide. Legal. As I stated earlier, there's prolific template use. If you read through enough of these PPMs and OAs, you'll start to see massive similarities regardless of the investment underneath it. There are a few aspects of, as you change investment types, this is my own, don't quote me on this. I usually think about 70 to 80% of your legal documents are all the same, and the other 20 to 30% is only differentiated due to the non-standardized aspect of what type of alternative you're investing in. So when you're daunted with the idea of, oh, I got to go read through these PPMs, well, if you've read a fair amount of them, you might be reading a lot of the same language, and you do what I do. I'm hunting for differences. I'm hunting for, do they have the core aspects that I want to see as protections and things that should be in a legal doc, but also what have they done differently from other docs I've read? And so that's one of the things you can kind of identify and then home in and generate due diligence questions out of those differences. I list here sort of the core documents. You're not going to receive all these from certain funds. Some that are smaller may not have DDQs. They may not have compliance manuals. But you should, in most of the funds in the alternative investment space, they'll have some form of offering memorandum or PPM or OA describing the base of the investment. They'll obviously have their marketing deck. You can value that at the level you want to. It is marketing. The DDQ, if you're unaware of what that is, it's a document that lists out how the company views what they've built operationally and structurally. Not everybody will have one. Your institutional quality ones will definitely have a DDQ. You should request it. If you've got a large organization that has a lot of people, they will definitely have a compliance manual along with their entire HR process and procedure. Obviously, you want to check entity verifications. Is this company in good standing? Is there licensing with the securities aspects in place? If they require SEC filing, obtain proof of that. And then, like I said earlier, policy and procedure manuals. If they have them, great. Walk through, understand how they think their company works and some of their SOPs, especially with regards to risk. One of the things here, I know a lot of people, I've had tons of people say, hey, I sent all this documentation over to my lawyer. Maybe that person's lawyer is great and they're multifaceted and they can understand the dynamics across the plethora of things that we've covered here, which is a lot. That's a lot to say one person's going to understand everything we just talked about. Handing these documents off and walking through and having just one lawyer do it, you need to really assess, is that person capable of understanding all the dynamics that you think you need to understand? Some of them might be, but you're asking a lot of your lawyer if you think he's going to understand every moving piece of an alternative investment and how to assess the level of risks, because that guy's not writing the check, you are. So, make sure you take that due diligence. References here. I've had this happen throughout my life. They want, current investors in a fund, past investors, why did they leave? Sometimes the past investors, they can be more difficult to get a hold of. But here again, if a manager is, understands how this game is played, hopefully they're ready for that. And then there again, you can also contact, and I did this a lot, was reach out to the service providers, the ones that are real key to the functionality of the fund and the investment, there again, there's a set of questions you can ask administrators and a variety of things. And, some you might get answered. Obviously, these service providers work for the fund. And it depends on the level of transparency the fund manager has, authorized them to share with you. Try to get as much as possible. But if you have the chance, call them or at minimum, just, oh, you actually work for these guys, right? Oh, you actually reconcile on a monthly basis. Great. Okay, at least go in and talk to someone at the company that can verify they truly work with the fund. So trust but verify always. At whatever level you can. Next slide. All right, red flags. And this starts to leak into a little bit of what we'll be talking for next time. Red flags, they're the key areas, like I said earlier. They've generated conflicts and problems in the past, and they repeatedly occur. And I'm not going to go through all of these because we'll talk about more of these next time, but I just kind of wanted to people who want to collect this deck for later and peruse through it. These are some categories that, regardless of the type of fund, have created issues, and some have led to full SEC indictments and huge fines for the funds, and some of them have literally caused funds to close. And like I said, we'll dive into some of these in the next one, so I don't want to steal all my thunder for section number 4, but this is sort of an intro into, and you can see the second one there is valuations. It is super important to understand how that works. I've DK'd a number of investments just on how they run their valuations. It was just too much of an open architecture where the manager just had too much control. And I just, and they didn't want to take on a third-party valuation. So I was like, fine, have a nice day. You just don't need my money. Don't be afraid to say no. I mean, this due diligence process, you got to come forward with what works for you. And the whole objective, I know this sounds kind of negative, but you're trying to get to the no quickly. You're trying to, you want to spend as little time getting to the no as humanly possible. And if everything keeps on kind of clicking forward, well, then, okay, it's a yes, 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 yes. And that, getting to a yes can take a long time. But getting to a no, you want it to happen very quickly. And some of these things that we'll talk about on the red flags, the things that you can dive in pretty quickly. All right, next slide is next steps. One of the things that people always ask is like, great, Chris, you've now bored me to death for the last hour talking about due diligence. What other resources can I possibly use to go and further educate myself? Like I said earlier, I work a lot with the CAI. It's a nonprofit organization that's simply focused on research, networking, and education and alternatives. Another great resource is the ilpa.com. It's a website to where it's literally an entire website built on education, a variety of different templates and ideas and discussions around LPs. If you're going to make an investment in an alternative investment, you are by definition an LP. And they have created, what is an ever-growing resource. And they talk a lot about rules, regulations, give you ideas. Continue to develop your network. Identify, maybe you're an expert in, venture, but, hey, I want to think about real estate. Well, okay, you might have a great venture network, but you should probably start building a network in, the real estate area for further education and also potential, access to deals. There's a number of different networks out there that can be a great start. And then, lastly is, if you have the money and the capability, maybe you're a small family office, maybe you're getting started, maybe you're someone who's like, hey, we've always been doing X. Like I said, maybe you're a family office that's specialized in venture and startups, and you want to add real estate to your portfolio. Well, how to think about due diligence, and one of the things that I've seen a lot of companies who have the size and the monetary capability, there are services available for access to data, research, and actual people who will perform due diligence. You can be like, hey, go out and look at this particular fund and tell me what you see and send me over the report. There are a number of different companies out there that perform that service. That's not, I know, very functional for the individual investor, because these services can cost a lot of money, but it's something to realize that they are available. And sometimes a lot of those services, you can go to Cambridge Associates and they have a lot of information that is just generally available for people who are wanting to go in and educate themselves. Same with Preqin. So, and obviously, I think one here in Seattle with me is PitchBook, if it's something you're really focused on, startups in the private equity world, another great resource. And all right, we already talked about what we're going to be covering, because we're going to be going through some of the questions on some of those red flags and diving into, if I am going to go tear somebody apart, what myself and many of my other colleagues that work professionally in due diligence, what do we actually ask? And we're going to walk through and give you actual questions that we go through to kind of go through and sort of start vetting. So I look forward to that. It'll be another one that hopefully we can get done in a timely fashion, because as you can imagine, this is a big investment space. It is, there's a lot of ways to go with this. So I hope I covered a number of subjects that are useful, created at least some areas of thought. And if you have any questions, fire at will.
Yes, thank you, everyone. Please type any questions that you have into the chat box so we can help answer those for you. One that we had come in, Chris, is if I did not do due diligence on my investment, is it too late?
No, it's not. If you were writing a check into something, it's always good to go back. I mean, you might be in an investment that's got, a liquidity issue where, you can't get out for a certain number of years, or maybe there's a lock period. That's fine, but it's not too late. You take a number of things that we've gone through and looked at, and you can go back and ask these questions and start filling in your file. Start building this good habit of, hey, before I do this, and I know there's sometimes a lot of pressure to invest fast. Hopefully that doesn't happen too often, because investing quickly without doing your research doesn't always end up being a poor decision, but it can. It increases the probability of it for sure.
Okay. Another one is due diligence ongoing? Meaning, should I do this on an annual basis?
Yes, that's a great question, because that is literally how one of the greatest frauds that everyone knows about got away with a number of things. Madoff and a lot of others were allowed to exist for an extremely long time because a number of investors, didn't continue to push with ongoing monitoring of the investment. I truly believe this, that no one wakes up and says, hey, well, not no one, there's always someone, but majority of people who are going to go in and do in the investment business and the alternatives, they truly do have a belief in the product they're creating, and they definitely start the day off right, and they truly are trying to do best for investors. Sometimes things can go wrong, they don't take correct actions, and then down the road there can be some fraudulent activity. And if you don't have ongoing monitoring of, or a set process that's going to be able to catch that, it's going to be a problem. Now, I will say this: if you have someone really, really super smart trying to defraud you 100% of the time, and you're spending 20% of the time trying to catch them, even if you have ongoing monitoring, it can be tough. And that's where, in today's world, that those third-party service providers hopefully have process and procedure in place that can help you with that ongoing monitoring and detect things that might go wrong over time.
Okay. Let me see. It looks like someone raised their hand here.
Oh yeah, we can definitely send a recording out and share the deck. I saw,
yep.
I had one question actually that the person was not going to be able to join, and they sent me this question. They were asking about checklists. This is a plague of the early days of doing due diligence. Is I walk in and I sit down with a manager and I have my checklist. Do you have a fund administrator? Yes, check. Do you have your prime broker, or do you have cash controls in place where it's dual cash control? Check. And all they're doing is really spending about 35 minutes in a conference room checking boxes. Checklists are very helpful to make sure you are not missing something you think is important, because as you can tell, there's a lot to cover. And when you get into the heat of it, you can forget things. So that is where a checklist is very important. To have a checklist as a primary proof of I've done my due diligence will get you in trouble. Because if I ask, do you have a fund administrator? Yes. Great, you check the box. Do you now understand, by the nature of that question and checking that box, how that fund administrator integrates with the fund and is properly assessing middle and back office functions, or running valuations, or reconciling bank account? You don't understand any of that. You didn't ask that question, and that's really not on the checklist. You got to go in and verify and ask that next level of question so you can take it off the checklist and into a level of, true understanding of, how the fund is built and how it operates. So I'm not, saying negative things about checklists, but don't think that's the end of the questioning. You've got to have another level that really dives a next level and sort of says, hey, how is this all working together? And there's tons of different checklists out there. I think like the ILPA actually provides a couple different checklists for you to start with. So if you don't have a checklist already, you can certainly use this deck and come up with a number of different questions and a variety of other things to hit. But there are other people out there. And I will tell you this, checklists are a little different depending on the alternative investment. Obviously, there's some things that I'm going to ask on the venture side that I may not ask on the hedge fund side and vice versa. So.
And then it looks like we had someone raise their hand. So I'm going to unmute. Let's see. Hi, Dulce. Did you have a question for us?
I think in chat, she was just asking, can we send?
Oh, was it the same one? Okay.
Yeah, I think so.
Okay, cool.
So yeah, the answer of that is yes.
Okay, awesome. Well, thank you everyone for joining. Chris and I are always available. So any follow-up questions, please let us know. There's a contact us that'll be directed towards Chris as well. Again, if you have any follow-up questions, and we will be sending the recording, which is also available on our website. So thank you for your time today, and we're excited for the next webinar. Thank you, Chris.
Thank you, everybody.